Hi, I'm John McElroy. Welcome to the presentation today on tax and residency in Canada. What's this video going to cover? I'm going to take a look at the four main residency questions that I hear the most often. Starting with, if you leave Canada, when do you stop being a resident of Canada? Number two, how do close calls get decided when residency in Canada is just not clear? Number three, other side of the coin, if you visit Canada and you stay too long, when do you have to start paying tax? And last, can you be a resident of two countries at the same time? And if so, do you have to pay tax twice? I'm going to work through all four of those questions. Why is there confusion in Canada over tax and residency? To me, it's the word resident. It's a common word. It's got a common meaning. But the tax meaning of resident, it differs from common usage. If I tell someone, I'm a resident of Toronto, what do they naturally think? They think, oh, I live in Toronto. In Canadian tax, resident has a broader meaning. Residency isn't limited to just where you live. Now, why is residency important when it comes to tax? Because Canadian taxation is based on residency. Residents of Canada are subject to income tax on their worldwide income from all sources. It's our basis of taxation. In the U.S., people are taxed based upon being citizens and residents. So if you're a citizen and you're not resident of the U.S., you still are subject to tax. Not so in Canada. Our taxation is based upon residence, and so residency is important. All right, we need to understand residency and tax, especially if we move between countries. So what's the most frequent mistake I see? Well, a Canadian resident moves to a new country, maybe a job or a relationship, and what do they conclude? Hey, they think, I'm not living in Canada anymore. I'm not a resident of Canada anymore. And so if I'm not a resident, I don't have to file a Canadian tax return or pay Canadian tax. Is that right? No, that's not necessarily true. And that's why I've made this presentation, is to cover off these issues. So what are the rules? If you leave Canada, when do you stop being a resident of Canada? Well, here's a surprising fact. You can't look up an easy answer to that question. Why? Because resident of Canada is not defined in any Canadian statute. There are no handy, convenient check-the-box rules which we can consult to determine if someone is or is not a resident of Canada. A bit of an odd situation to some people. Canadian legal statutes impose tax obligations on residents, but Canadian legal statutes do not define who is a resident. So then how do you determine if you're a resident of Canada? Well, residency has been determined by the courts through case law. The most often cited case is Thompson versus the Minister of National Revenue. I mean, it's 70 years old plus. And the wordage used there was, residence is a matter of the degree to which a person in mind and fact settles into or maintains or centralizes his ordinary mode of living, with its accessories, social relations, interests, conveniences at or in the place in question. That's a big word salad. When we're done this presentation, hopefully you're clear on what it means. But keep in mind, residency is decided case by case by case by case based on relevant facts that apply to the individual and the situation. And since residency is decided case by case based upon relative facts, that's the word that's used, factual resident. Who is a factual resident of Canada? Well, a factual resident of Canada is someone with significant residential ties to Canada. If you're living a normal life in Canada, you have many residential ties. You're a factual resident, no question about it. But what if you move away? If you move away from Canada, you actually remain a factual resident unless you sever all significant residential ties with Canada. Okay, what constitutes a residential tie with Canada? Let's get into the nitty-gritty. Well, residential ties with Canada come in three categories, from most important to least important. There are significant ties, secondary ties, and other ties. Let's start with the important ones, the significant residential ties. There's only three, but they are all really important. The significant residential ties are a dwelling place available for use, a spouse or common law partner in Canada, and dependents in Canada. Any one of them normally means you have maintained residential ties with Canada, even if you personally have moved out of Canada. Now, when it comes to a dwelling place, for it to automatically make you still a resident of Canada or maintaining residency has to be available for use. If you have a dwelling place available for use 24/7, bingo, your residential ties to Canada have been maintained and you're a resident of Canada even if you live somewhere else. If you have a dwelling place, maybe you own a home and it's leased to a third party, it's a little less clear in that case. Maybe this real estate market was soft and that's why you couldn't sell it. And as long as you're leasing that property to a tenant who operates at arm's length to you, you might be able to get away with that one. But if it's available for use, that one is a no-brainer. If you have a spouse or common law partner living in Canada and you're not separated or divorced, bingo, residential ties are maintained. You're still a resident of Canada even though you moved away. Same with dependents. If you have dependents living in Canada and you're not separated or divorced from the spouse who's looking after those dependents, bingo number 2, you are still a resident of Canada, you've maintained your ties, and even though you live somewhere else, you are still a resident of Canada and subject to Canadian taxation. So remember, maintaining any single significant residential ties means you are still considered a resident of Canada for tax purposes. Let's move down to the next category, secondary residential ties. Now, any single secondary residential tie is not by itself necessarily enough to maintain Canadian residency. CRA looks at them all collectively. But what are they? What are the secondary residential ties? Let's take a quick look. First one I'll address, personal property in Canada. You leave Canada, but you leave behind your furniture, clothing, cars, RVs, your stuff. If you go but your stuff stays, you've got a secondary residential tie to Canada. Social ties are secondary ties. Fraternal, religious, or social clubs. You belong to the Granite Club and the Boulevard Club. You belong to the Knights of Columbus. You belong to Toastmasters, the Optimist Club. Those are social ties. They're evidence of a secondary residential tie to Canada. Economic ties are secondary residential ties. Canadian job with a Canadian employer. Notice that's not a significant tie. People can work for Canadian employers and have jobs in Canada and not be residents of Canada. It is possible. If you're active in Canadian business, maybe you've got Canadian bank accounts and RSP accounts, maybe you still have credit cards or stock trading accounts, all evidence of economic ties. If you are a landed immigrant and have a valid work visa, that's a secondary tie. What about health cards or medical insurance? In Ontario, it's an OHIP card. If you have an OHIP card, yeah, that's a secondary residential tie. So is a driver's license issued from any Canadian province or territory. If you have a vehicle like a car with active plates registered in a Canadian province or a territory, that's a secondary residential tie. Same with a cottage or cabin that's available for use in Canada. If it's a main dwelling place, that's a significant tie. But if it's an out-of-the-way cottage or cabin that's available for occasional use, then it becomes a secondary tie. Canadian passport, secondary tie. If you're a member of a Canadian union or a professional organization, you belong to the UAW local, or you're a member of the Law Society of Upper Canada, that is a secondary residential tie. As mentioned, a single secondary residential tie is not enough for you to maintain your Canadian resident status. They're looked at collectively by CRA. Last category are other residential ties. These are the small ones, the itty-bitty ones. It's when you retain a Canadian mailing address or a P.O. box or a safety deposit box. You got stationery or business cards. Keep your telephone listing. Your local newspaper or local magazine you have a subscription to and you use a Canadian address for some of these things. That's evidence of other residential ties. Limited importance, except in combination with other secondary ties, but they are worth noting. So if we're going to summarize, we have significant, we have secondary, and we have other ties. Clearly, significant ties are the more important. The other ties are the less important. I'm going to look at some examples, and when I do, the significant ties will be in yellow, secondary ties in green, other ties in red. You're living in Canada, you're living the life. You got a bank account, you're in the phone book, you've got a place to live, a spouse, RSP, cottage, driver's license, health cards, passports. You got the whole ball of wax. What's your status? Well, I don't think there's any question there, is there? You're a resident of Canada. But now you move abroad. You leave Canada. I want to take a look at you leaving Canada under 3 different scenarios. First one, when you maintain your residential ties. The second one, when you make a clean break and you have no ties left. And then the in-betweener, when you keep some secondary and other ties, so it's maybe not clear cut whether you really did leave or not, or you're really no longer a resident. You left, but are you really no longer a resident is really what I meant. So the first one where you maintain some residential ties, or you maintain your residential ties. Here's what I'm talking about. You leave Canada and your spouse and your children go with you, boom, they're off the board. You close your bank account, you cancel your driver's license, you're shutting down ties. You even sell your cottage and cancel your health card. And to top things off, you close your P.O. box and dissolve your RSP account. This is the way it's left. What's your status? Are you still a resident of Canada? Do you have to file and potentially pay tax in Canada? The answer here is yes. Why? Because you maintained a single significant residential tie, and that's all that's needed. That means you have maintained a residential tie in Canada, and even though you don't live in Canada anymore, you're still a resident of Canada for tax purposes. You are what we call a factual resident of Canada, and potentially liable to pay tax in Canada. Let's look at the second scenario. You're living in Canada, same profile. This time you make a clean break. There are no ties left. So this time you get serious about it, you're systematic, you're thorough. You get rid of your significant ties and you go through the list. Every single one of them you shut down. When you're done, you have none left. All residential ties are severed. That's what we call the clean break. If you make a clean break, what's your status? Oh, that's clear cut too. You are a non-resident of Canada. You have no requirement to file and pay tax in Canada, except of course if you have income earned in Canada. So the first one was clear cut. You maintained a significant residential tie, you're still a resident of Canada. The second one, you broke every single tie, you're clearly a non-resident. What about the in-betweener? You maintain some secondary and other residential ties. So this time you do get rid of all your significant residential ties. Spouse and children come with you, you shut down your dwelling, they come off the board. And then you eliminate as many secondary and other ties as you can. And then they come off the board. But you had to maintain a Canadian bank account for important reasons. You didn't want to cancel your driver's license because you figured you needed a license in your new country until you got one issued by that country. You forgot about the P.O. box, and the safety deposit box was a little bit delicate for maybe family reasons, and it didn't get shut down. What is your status now? Are you still a resident of Canada? In this case, we'd say, you know what, the facts are inconclusive. CRA would say another level of analysis is required in a situation like that. So let's make sure we're clear where we are here. You are physically absent from Canada and maybe have been for a while, but not all residential ties have been severed. So what's the analysis required to determine? Well, what is the significance of those residential ties? And this is a beautiful segue into our second question. How do these close calls get decided when it's just not clear whether you are or are not a resident of Canada? Well, the analysis is really undertaken to try to determine the significance of those residential ties. So CRA might look at the evidence of your intention to permanently sever your residential ties, steps that were taken to comply with the Act, the regularity and length of your visits to Canada, whether you've established residential ties elsewhere. Go through these fairly quickly, but they're important, so I do want to make a couple points. If we're looking at the evidence of intention to permanently sever residential ties, what are we talking about here? What could this evidence be? Well, it can take a lot of forms. In the interest of brevity, I'll only mention one. Let's say that you have plans and there's evidence that you have a job in Canada to come back to once you're finished working abroad. Well, that's important. That's relevant. If you still have ties and plus you've got plans to come back, it'd be very easy for CRA to conclude that, in fact, you know what? You never really meant to leave. You're still a resident of Canada, even though you're temporarily living overseas. But here's a point a lot of people miss. This is only relevant when there's no clean break that's taken place. That's important to understand. If you live in Canada and you move, now you're living abroad, but you maintain some ties like we did in this case, CRA has to decide how significant are those remaining ties, and that's why the analysis is undertaken. And evidence of plans to return to Canada are relevant. CRA might conclude those remaining ties are significant, and decide, you know what, you're still a resident of Canada even though you're living somewhere else. Same scenario, you live in Canada, you move abroad, but you made a clean break when you left. If you made a clean break, there is no more analysis that's needed. And in fact, even if there is clear evidence of plans that you're going to return to Canada, they're actually irrelevant. They don't factor in because a clean break makes you a non-resident. And all kinds of non-residents have plans to someday move to Canada and become a resident. You're no different from them. And your plans to come back to Canada are irrelevant for the purposes of taxation if you made a clean break. Number two, steps taken to comply with the Income Tax Act. I'll just mention a couple. Here's one. If you really were departing Canada permanently, you have a deemed disposition of all your capital property. That's part of the tax rules. And tax rules require you to post the deposit against any tax owing on the capital gains realized. So the analysis might be, CRA wants to know, hey, did you comply with the Income Tax Act and post the deposit that you should have to cover the tax you have to pay on the deemed disposition of all your capital property? And obviously, if you didn't, they take that as evidence that you didn't really sever ties. If you did, that works in your favor. Let's take a look at another one. Canadians, of course, must withhold tax on any interest, dividends, or royalties that they pay to non-residents. Well, since you are now supposedly a non-resident, you need to instruct people that are paying you interest, dividends, or royalties to withhold tax. And of course, CRA naturally wants to know what? Did you instruct those individuals to withhold tax? If you didn't, again, evidence that you really are still a resident of Canada. If you did, works in your favor. Regularity and length of visit to Canada. If you make occasional visits for personal business, that's fine. But if you maintain some secondary and other ties, and you make regular visits to Canada, CRA might conclude what? You never really intended to leave. You are still a Canadian resident for tax purposes. And finally, did you make residential ties in your new country? If the answer to that is no, that adds significance to the remaining Canadian residential ties that you have in place. All right? That could support the idea that you're still a resident of Canada even though you moved away. If you did make residential ties in your new country, that lessens the significance of your remaining Canadian ties. But, this is important, even if you've made new ties, that does not by itself mean that you are no longer a resident of Canada. Let's be clear, you can be a resident of two countries at the same time. Right? This is in fact a big issue when it comes to tax and residency. Okay, let's switch gears. If you visit Canada and you stay too long, when do you have to start paying tax? When are you deemed to be a resident of Canada? I want to get into this whole idea of being deemed a resident. Deemed resident is a little different from factual resident. Factual resident, that's determined by Canadian case law. Deemed resident, that's determined by Canadian statutes. In fact, it's right in Section 250, subsection 1 of the Income Tax Act. What does that mean? It means even if you haven't established enough residential ties to be factually resident in Canada, if you sojourn 183 days or longer in Canada, you are a deemed resident of Canada. And, of course, you are subject to Canadian income tax on your worldwide income from all sources. Now, one area of confusion that does crop up, if someone spends 183 days, or parts of days for that matter, in Canada, are they automatically a deemed resident? And the answer to that is no. It depends on your status. Because the Income Tax Act clearly says you have to be a sojourner. And the 183-day rule does not apply to non-sojourners. So what is a sojourn? Well, to sojourn means to make a temporary stay in the sense of establishing a temporary residence, although the stay may be of very short duration. So in other words, you're there to kind of partake into everything that location offers. It's as if you are a resident and you're enjoying life in that new location. Maybe some examples will make it clearer. Let's say you have made a 185-day vacation frolicking in Canada. Are you a sojourner? Non-sojourner. In this case, You're a sojourner, which is going to make you a deemed resident of Canada because you've partaken in Canadian life in its kind of fullness for 185 days. You don't have access to all the services that factual residents have, but you've been living the Canadian life. That's different than, for example, if you live in Buffalo and your job is to make a delivery in Toronto every single workday, and when you're done, you get in your vehicle and you drive back to Buffalo. Sojourner, non-sojourner. In this case, I'd say non-sojourner. You're not going to be a deemed resident just by virtue of the fact that you spent more than 183 parts of days in Canada making that delivery. That's not going to be enough. You're not going to be a deemed a resident of Canada. We could take it up a notch. You live in Lewiston, New York, on the U.S. side of the Niagara River. You work across the river in Canada in Welland every day, but you drive back to Lewiston when you finish work. Sojourner, non-sojourner. In this case, I would also say non-sojourner. You're not a deemed resident just because you go to Canada to work. This surprises some people that people can work in Canada every single day and not be necessarily a resident of Canada, but it's definitely possible. However, let's look at this example. If, say, you live in Detroit and you work every morning in Windsor, say from 8 a.m. to noon, but then you spend the rest of the day socializing with your friends, participating in life in Windsor, maybe till 11 or 11:30. Then you drive back to Detroit at midnight. Sojourner, non-sojourner. In this case, we might say you're probably going to be a sojourner under Canadian tax rules. And in fact, that could indeed make you a deemed resident if you're doing it every day and you get to 183 days or more. Now, whether you are sojourning or not in Canada on any given day is a question of fact. All right, so it's like most things in tax, it's going to be decided by the facts. Okay, let's turn our attention to the last question. Can you be resident of two countries at the same time? And if so, do you have to pay tax twice? First question, can you be resident of two countries at the same time? The answer to that is a clear-cut yes, no problem. It's a big issue in tax and residency. Well, do you have to pay tax twice? And the answer is not necessarily if you qualify for treaty relief. All right, to qualify for treaty relief, the treaty has to apply. When does it apply? Well, a couple of conditions really are relevant. Number one, Canada has to have a tax treaty with the country where you originate, if you're a visitor to Canada, or the country where you are moving to, if you're moving abroad. And number two, you have to be subject to as comprehensive a tax liability as is imposed in your original country if you're visiting Canada, or the country you're going to if you're moving. What does that mean? It means that you can't treaty shop. You can't be under a special program or subject to special treatment. Let's say you're a sophisticated, wealthy resident of Canada. You move somewhere else, but you specifically choose a country because in that country, under some special program or rules, you're only going to be subject to a trivial amount of tax. Canada's not going to accept that you're going to escape the Canadian tax net by moving to a country that charges you a piddling amount of tax under some kind of special program or special treatment. So unless in that country you are subject to as comprehensive a tax liability as is imposed in that country, then you're not going to be able to apply for treaty relief under that treaty. But if both conditions apply, as a dual resident, you are entitled to treaty relief, and you do not necessarily have to pay tax in both jurisdictions. If treaty relief is available, one important question is, does Canada charge and collect the tax? Or does the second country charge and collect the tax? It applies to both, whether you're moving to a country, that being the second country, or if you're from a country and you're staying longer than 183 days in Canada. It really does apply to both, even though I'm, in this example, talking about people who are visiting Canada. But how does it get decided in terms of who charges and collects the tax? Well, we have tiebreaker rules that decide it. They're extremely important. Tiebreaker rules really apply a two-part test. Number one, the permanent home test, and number two, the center of vital interest test. Extremely important part of tax and residency. How does the permanent home test work? If an individual has a permanent home in only one country, that country is deemed to be the country where the individual is resident. And in fact, the second test, the center of vital interest test, can be ignored in this case. Now, if an individual has a permanent home in both countries, now you do have to apply the center of vital interest test. What is the center of vital interest test? It's kind of like a scale. Canada on one end of the scale. We have the second country or other country on the other end, and now we're just kind of weighing things out. We take a look at things very similar to the residential ties that we already looked at as they pertain to Canada. Family, economic, social relations, occupations, political, cultural, place of business, etc., etc. Which country is the stronger center of vital interests? If you have a permanent home in both countries or neither country, it's going to come down to this. That is the country that will charge and collect tax. Okay, let's take a look at the big picture. Practically speaking, both individuals leaving Canada and people visiting Canada for an extended period of time, i.e. people who go to or are from a treaty country, are really in the end depending upon permanent home available as the critical factor. That's what it boils down to. Are you leaving Canada and moving to a treaty country? You know what? You'll very likely be establishing residential ties in that new country. So even if CRA determines you have maintained your Canadian residency and you're a dual resident, the tiebreaker rules are going to kick in. And they're going to make you resident of the country where you have a permanent home available. Practical tip: if you haven't made a clean break, which really is the best course of action, have your only permanent home in the country where you want to be taxed. Don't keep a permanent home in both countries. And the very same thinking applies to people on an extended visit to Canada. Even if your stay extends beyond sojourning 183 days, and therefore you are deemed to be a resident of Canada, if you are from a treaty country, the tiebreaker rules kick in. And they're going to make your country of residence the one where you have a permanent home. In that case, keep a permanent home in your country of origin and don't establish a permanent home in Canada. What are the takeaways from this presentation? Number one, the big one, if you're leaving Canada, familiarize yourself with the Canadian tax residency rules. Don't make that mistake of thinking, I don't live in Canada anymore, so therefore Canadian tax rules don't apply to me. All right? You need to get into some depth in terms of where you're really at when it comes to tax and residency. Same thing applies if you're making an extended visit to Canada, you're sojourning 183 days or more. You need to understand how these Canadian tax residency rules work. Number three, if you're moving abroad, consider submitting defensive Canadian tax filings, even if you believe you're not required to, at least for a couple of years. They can come in very handy if you run into problems later, and that's typically when you do run into problems later. Number four, understand the treaty relationship between Canada and the country you're moving to if you're emigrating. Make sure there is a treaty, understand how it works. If you're making an extended visit to Canada, you need to understand the treaty relationship between Canada and the country you are from. The treaty relief can be a lifesaver. Make sure you understand whether you have a treaty and how it works. If you are at risk of being ruled a dual resident, maintaining a permanent home only in the country where you wish to be taxed is probably the best advice someone can give you. If you do have a permanent home in both countries, familiarize yourself with the Center of Vital Interest tests. All right, those are the good sum-ups. I will say good luck, and of course this isn't tax advice. If you are staying in Canada more than 183 days or emigrating somewhere else, get some tax advice, talk to somebody, right? We can't give specific tax advice in any video. But happy travels. I'm John McElroy. This is Tax and Residency in Canada. If you got something out of this video, really important, please like the video. If you've enjoyed any of the videos on this channel, subscribe to the channel. The more subscribers we have, the more people like the videos, the more indication we have that in fact people are getting something out of these videos and they are something that we can continue to invest time in making. I really enjoy doing them. So people sometimes ask me, John, do you consult with people who watch these videos? The answer to that is yes. I have a normal practice where I consult with clients, but I also have a YouTube practice where I specifically consult with individuals who have watched these videos and have questions and want things to be sorted out and someone to help them walk through it. And psst, don't tell my regular clients, but in fact my YouTube clients get a special rate. I like doing the work so much, I charge 1/3 of my normal rate to my YouTube clients. So yeah, by all means, give me a call or email me, even better. I usually have a better response to email. Hope you enjoyed the video. Meanwhile, we'll see you in the next video.